Chuck Cornville, I'm the Chuck in the Markets Up, Chuck. And, today's blog is really talking about growth and income opportunities that have been created by the recession because, there's still a lot of talk that the market's rallied and recovered, and it's general talk about the stock market. But I'm going to show you here that there are, over the next 3 days, I'm going to cover 15 stalwarts, what I call stalwarts or what some people might call blue chips, extremely high quality, recognized companies that we all will, you'll recognize certainly the vast majority of them, that really the recession has created an unprecedented opportunity to buy these stocks at a very low valuation, get a high dividend yield, and a dividend that you can, I think, rationally expect, certainly the odds are in your favor, that would increase year after year as the recession ends and these companies get back into more normalized growth phases. So the first one I'm going to show today is Coca-Cola, and I want you to notice if you look at the last 20 years, Coca-Cola has very consistently grown earnings at about 9.8%. That's just under twice as fast as the general market, I might add. And then the light blue shaded area you see here are the dividends, and they come out of the green earnings area here, but I plot them on top just so you can see them visually. But the point is, I want you to notice that the dividend line has increased so as inconsistently with the earnings line. And what you really have here is a situation where you can buy Coca-Cola today. As you can see, the market has normally capitalized this company at a price-earnings ratio of, somewhere in the 20s. In fact, there were periods up here during the irrational exuberant period was much higher than that because of the quality of the company. You would normally, I'm going to guess, buy this company with a dividend yield expectation of maybe 2.5%. But today, because the price is so low, there was a kind of a weak year last year in terms of earnings, but they are expected to get back on track. Current consensus forecast for Coca-Cola is to grow at about 8% a year going forward, and I think that's kind of pessimistically biased because of the recession. But assume they grow at 8 or 9%, then I would think you could expect your dividend to grow at 8 or 9% a year as well, because companies like Coca-Cola have a long history of increasing their dividend, and it's very important to them. But the point I want to make is this. I think the stock price fell significantly below what it should have been. Any other time the price was below its earnings justified line, as you can see, or even touching the earnings justified line, were good times to be buying Coca-Cola. I don't think today's any different. If you look at it from a long-term track record perspective, $100,000 in Coca-Cola on December 31st, 1990, you'd have seen your dividend increase, virtually every year during this period of time. You would have started out back then at a 2.1% yield. Today, because valuation is so low, you can get a 3.3. That's just almost paying what a Treasury bond is currently paying. A Treasury bond is only paying 3.36% today. But the difference is when a Treasury bond, maintains the same payout year after year after year, you could expect the income from your dividends on Coca-Cola to increase every year. Plus, you get an opportunity to see a little bit of growth. Plus, you get an opportunity to get some leverage from the price going back to normal valuation. So, Coca-Cola is my first example that I'm going to, that I wanted to show to. My second example is McDonald's. I'm going to go a little faster now. Again, anytime the stock was under its earnings justified line or its normal price earnings ratio, which in Coke's case has been 19. Have been great times to buy it. You can buy McDonald's today with a 3.1% dividend yield and a reduced stock price. Over the long run, you can see McDonald's has historically increased their dividend year after year after year. It's generated a rate of return for its shareholders significantly greater than the stock market itself. It's forecast to grow at over 9% a year going forward. And the bottom line is you can buy this great company on sale with a nice dividend yield and an expectation of making some nice profits as the economy stabilizes, and this company will grow again and more than likely raise its dividend. My third example is Procter & Gamble. Again, I want you to notice how consistently this company's stock price has tracked earnings. A little flattening in earnings due to the recession. The stock price is off precipitously. We have a 3.1% dividend yield. Just like the other two, we have a legacy and a history of increasing the dividend every year. We have a very nice track record of forecast growth of 10% going forward by the consensus of the leading analysts. So you can buy this stock at a 3% dividend yield, get some leverage and if the stock goes back to its normal valuation, and at the same time pick up a growing dividend income stream. Another example of a blue chip growth and income opportunity. My fourth example is automatic data processing, payroll processing. Again, I want you to see the strong correlation between earnings. There are times when the price gets disconnected. It always comes back to earnings. Right now, it's trading significantly below its earnings justified level. I think that, in other words, the price has fallen more than earnings than the earnings issues that they had because of the recession would justify. You have a 3.3% dividend yield, and another example of a company that's steadily increased its dividend over the years. You could expect this company to grow at 11% a year is the forecast. It's the fastest of all that I've shown so far. So you can expect to see the stock go back to a normal valuation, grow at 10 or 11% from there, and give you a 3.3% dividend yield that's increasing every year. And there you have it, 4 examples of companies that have over a 3% dividend yield that you would hope that would increase year after year. Good, high-quality companies, some of the highest-quality companies your mind can conceive. They're on sale, and things look very promising. It's a great time if you were even coming close to retirement to build a portfolio where you could have an inflation hedge and see your income increase as well. I do encourage you to do your homework on each of the companies. This is based just off of the screen and the charts we use. But tomorrow I'll show 4 more, and on Friday I'll show an additional 4. This is Chuck Arnold saying, look forward to talking to you again tomorrow. Thanks for listening.